Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending Feb 19, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is a delicate balance. I'll share a little bit more about that in just 1 minute. But first, let's take a look at how we fared this past trading week. This holiday shortened trading week, I might add. So if we just come in here and take a look, we'll first start off with the weekly sound bites here and the index performance. Taking a look at this, we can see that for the week, the only index that finished in the green for the week was the Dow, but just barely 11 basis points. S&P, Nasdaq, and Russell all down in the red for the week, but that's okay. We've had such a strong run in the month of February that a little bit of a step back and a consolidation or resting period is a good thing. You can see year to date, everybody's comfortably encased in the green, with the Russell leading the way at 12.88%. As money continues to pour into the small and mid cap index. You can see the valuations there too. The current forward 12-month PE ratio is still fairly high by historical standards, around 15 or 16. The forward is at 22.92. And the S&P dividend yield 1.48%, slightly higher than the 10-year Treasury at 1.345%. Now the Treasury's moving up very strong. The spread between the two is only 9 basis points, so it's almost 9/100%. So you can see here that it's making it harder and harder for big money to get a little bit of an edge by going into equities, but equities are still performing, so money is still going to go there. You can see the current VIX is up for the week, a little bit over 10%. It closed the week at 22.05. So we're still seeing an elevated volatility index. It's still staying bid. You can also see the sector performance for the week. Energy was the best at 2.72%, and for the year, amazing 17.84%. I talked last week about what I see are signs of inflation on the horizon. If you look at all the commodities, they're all up, from the ags, wheat, corn, soybeans. You're seeing energy up all across the board. Even lumber. I mean, the lumber index, lumber futures are up dramatically, and that hadn't slowed housing down at all. The worst performer for the week is healthcare, but year to date, it's still consumer staples at 7.73%. Okay. I mean, if we take a look at it on the U.S. index performance, we're seeing that there is this push-pull, or this delicate balance, as I indicated, between um, more stimulus coming in, more money coming into the markets, which they always love, obviously. More vaccines, hopefully, more companies opening up across the country, and that's counterbalanced by increasing interest rates and rising inflation expectations. Now, you can see there that the 10-year Treasury is still well below 1.5. Now, I think once it gets over 1.5 to that range of 1.5 to 1.75, you're going to see it start to tug on the purse strings of equity markets. I don't think it's going to be too much of an inflection point this year, unless we do have inflation moving up very fast. But I think where it's really going to start to show up, especially if wrong way Biden gets his 1.9 trillion relief stimulus package injected into the economy. I think that's too much. Personally, I think it should be more focused, probably about 500 to 600 billion on just the people and small companies that got trashed. But when you see, and when I see, a stimulus of 1.9 trillion, that means there's money for everybody, and they're just throwing it out the helicopter, a la helicopter bin. Really not a good thing, guys. Anytime the government assumes a larger and larger percentage of the U.S. economy and GDP, like they're doing with the stimulus, it takes away from productivity, and it also creates more poor people. It takes money away from the middle class, and we're becoming more and more like Europe. And apologies to our members over in Europe, but it just makes it much more difficult to grow, and it makes more people dependent on the U.S. government, which is a never-ending kind of thing. I think it's the wrong way to go, but we'll see. That's why I call him wrong way Biden. Everything he does is just not really, in my mind, the best way to go from an economic policy standpoint. But anyway, that's what we're seeing right now over in the U.S. Now, if we look at the data, the economic data that came out this past week, we saw that the PPI data increased 1.3% in January. That's the biggest increase, I will point out, since December 2009, hence potentially rising inflation. Retail sales also jumped up 5.3% in the month, well above the consensus expectation of only 1.1%. So we're seeing the strength in consumer spending and the producer price index, which is in a way a measure of inflation at the wholesale level. We're all, and I think a lot of that increase in retail spending was attributable to the $600 direct payment to lower middle income folks as that part of that direct check. We did see weekly jobless claims, however, jump up. It went the wrong way, back to 861,000. That's the most since mid-January. And housing data also uh, surprised on the downside, right? Housing starts falling back substantially lower than their 14-year high. But again, as inflation starts to embed itself in the U.S. economy, all those things that, and interest rates higher, those things that tend to be interest rate sensitive are going to get hit a little bit more, right? Um, inflation worries, all of this stuff is also pushing, as I said, the 10-year Treasury yield to 1.345, as you can see on the screen. Although minutes released from the FOMC meeting shows that Jerome Power Ranger Boom Boom Powell is still committed to this massive stimulus and keeping rates low. So there's going to be this delicate balance, and sooner or later, one side is going to break. And I believe it's going to be the inflation interest rate side. Once it starts running, it's very hard to control. Now, if we go across the pond, take a look at Europe. You can see here, I'm including the European stocks index also in here. That is 50 of the largest companies across Europe, made up of, about 35% of it's from France, about 34% Germany, and so forth. You can see everybody's in the green though, year to date, with the leader, the Hang Seng, the Hong Kong index. And for the week, surprisingly, we had a rare divergence. Most of the indexes from the FTSE, CAC 40 to Nikkei, China, Hang Seng, all in the green for the week. The only exception was the DAX, the German index. It was underwater 40 basis points for the week. But year to date, if you look at all the indexes, they are all up. Nasdaq, or the Russell index, the small and mid cap here in the U.S., is leading the way at 12.88%, with the Hang Seng kind of bringing up the rear. Okay, so we're seeing some of that. We're also seeing the German 10-year Bund. They call it the Bund, not the bond. It's actually still below zero at a minus 32 basis points, but it's up off its lows, right? And it's the highest that it's been since this past summer of June 2020. Okay. So we're going to see how all of this stuff plays itself out. Now, of course, if we look at one final major index, which is China, their shares, most of them were on a holiday shortened week. They only came back, their markets reopened this past Thursday because they're on their Lunar New Year holiday. It's a week-long holiday. I wish we had that, but they're on this week-long holiday, opened just back up this Thursday. All right, so the index was up for just those 2-day run. Okay. Pent-up demand, however, across China, they're trying to convert from an export-driven economy to a consumer-driven economy. So there's a lot of speculation that there's going to be a lot of consumer spending and travel in the coming months in China as they get their COVID vaccines out and everybody gets good over there. So we're going to see that's going to play, I think, pretty heavily as we go through the summer into the end of the year in the U.S. markets. What I'm going to do here, let me just shift over to our screen and let me just show you some key charts here. I'm going to start off with the 4-hour chart, which, as you guys know, I like that better than the daily, to give you kind of an x-ray view of, it's good for swing trading. It's also good for near-term trading action. And you can just kind of use it as a swing trade tool if you'd like. But if we take a look at the 4-year, and this is the E-mini S&P 500 futures, okay? So if you take a look at it, you can see here that we're on this little pullback. I've got the fib nodes plucked in here from the lows that we made back over here in end of January, beginning of February, right here. We were actually in the red on January 31st, right? We were in the red. There's the closing price. So above that blue line, we're in the green. Below the blue line, we're in the red for the year. You can see we've moved really from a low back here of 36.56 to now we made a high of 39.59, hundreds of points in a very short period of time. So a little bit of a rest pullback can be expected. If we look at the Fibonacci nodes, that would be the pivot low, and the pivot high was the recent high that we made back here on February 15th. You can see that the 236 fib node, we've got a lot of support at that level. In fact, you could probably say that the 236 fib node is also acting almost like a head and shoulders neckline. If I were to draw that in there like that, you can see we've got a head, our left shoulder, our right shoulder. Now we're kind of coming in here and testing that again, that being the left shoulder, of course, this being the head, and this being the right shoulder, right? If that level breaks, we're probably going to come down and test this next fib node here of around 38.42. And then I would probably be more inclined to see a 50% pullback right around the 3,800 level. That would be a normal pullback and yet still maintain a very strong bullish position. And that is really nothing, guys. I mean, it is really almost nothing. If we take a look at the S&P year to date, just this move right here, again, this is an hourly chart, that's a little bit over 4%, right? So if we take a look at this and say that's about say on average, about a 4% move, a 4% pullback is nothing. Again, we're looking at a 4-hour chart. So pulling back to that level there would, to me, just be an opportunity for buyers to step in if we get that signal. Again, with this head and shoulders, you got to break that neckline there to get a signal. And then if we break the neckline, we'll probably come up and have a retest. And if the retest fails and we come back down and we take out that prior low below the neckline, then we're going to come down, I think, to the 3,800. Now, for those of you that follow me and our members too, we've been fairly accurate. I've been fairly accurate in calling some of these pullbacks. I'm even a little bit early in the pullback that we had last September, calling that for July, August time frame, but it hit in September. It was about a 10% pullback. I'm looking now, because of the momentum to the upside, for another 10% pullback. And I was saying sometime in Q1, but we only got about 5.5 weeks left in Q1. So that would put us into early to mid-March to see that kind of pullback. I do believe we're going to have buyers come in. I'm still of the opinion, and looking at the charts and just interpreting them, that we can run up to 4,100, up to 4,300. In fact, Goldman Sachs is calling for 4,300 based on earnings projections from a bottom-up earnings per share analysis. That's what they're thinking. But we'll see how this thing plays itself out, okay? If we move over, and let me just shift the screen just a little bit here, and I'm going to take it to another view on another chart. Let me just move this over like this. So the screen is going to go blank for a minute before I get the screen up for you guys. We're going to have another view of the E-mini S&P 500 futures, and then I'm going to wait for that to come on the screen, and then we're just going to go over. We're going to take a look here. If we take a look at Nasdaq, all right, if interest rates start going higher and we start to see inflation start to come in, growth stocks like tech don't like higher interest rates, okay? And this could be a little bit more of an ugly pullback. So be careful with the Qs and technology. It's been a really good trade. And if we look at the FANG index that I've got here, you can see on this FANG index, in fact, we made a new high right here on the FANG index, okay, all-time high on the FANG. And then we got a little bit of a divergence here, not much, almost, actually there is zero divergence in here. So that does suggest a pullback probably would be picked up. Okay, but on this FANG index, I'm incorporating Microsoft, Facebook, Apple, Netflix, Google, and Amazon, the big guys. If we do see a surge in interest rates and a surge in inflation, you probably want to reduce some of your allocation or not play these guys because they just won't be that kind to you. All right. Shouldn't be at all. If we look at the Russell, now the Russell's the one that's been on fire. Okay. You can see the Russell. If we go back to when we really made that move in the Russell in November of last year, the Russell was well below even the 2019 close. And it started in November, or 2020 closed. It started in November 2020, and then just a huge run up, huge. And now we're coming down off of this Elliott Wave 5. So typically you get kind of an ABC or zigzag pattern taking us down to the 50 EMA. We do not have any divergences in the MACD. So again, any dip here is probably going to be bought. And if it does find itself down around the 50 EMA, I would be more of a willing buyer than a seller of it. And if we look at the all world index from Vanguard, you can see here, let me just get it corrected here. We're continuing to make new highs. So, and again, we're getting this divergence every time we make a higher high. We get a little bit of a divergence, and a little bit of a pullback to me is in order. In fact, that's what I'm expecting across most of the trend. And if we look at volatility, volatility stayed bid. You can see here, vol has been moving up. Actually went into the light red colored or rose colored area for a bit before moving back down and closing right on that line. But we've been elevated for quite some time, and we just cannot seem to break this bottom area here around 20. We got into the 1997, but at the end of the day, it's a lot more elevated than it should be with prices at all-time highs. All right, we should be in the 15, 14, 13 area, but the volatility is staying elevated, and you gotta respect that. If we look at the skews, if we look at the front month skew of all, there is nothing here that appears to be out of order. We're in the green, so that just tells us that we're in a normal contango in vol. That means the back month vol futures is higher than VIX, which is what it should be. And then if we go out to the March April timeframe, you can see here still looking very good, where there is no skew at all that would indicate some bit of worry in the volatility markets. And then if we go all the way out to April May, again in the green. So I'm not seeing skews out here at all that would indicate the markets have any bit of worry as we come through February into the end of Q1. Now, it won't take a lot to change it, but it just suggests to me that any pullback that we get, I don't think that buyers are going to start dumping. If anything, I think buyers will wait for a dip and then pick up some stocks on the way as it finds a bottom. Let's look at the bond market. Now, the bond market has been part of what I've been saying is low-hanging fruit, guys. And I've been touting this thing. Our members that have been following the trades and trade suggestions on bonds should be up very nicely right now. Whether your futures or TLT put action here, you can see, as I've been saying, every time, if you miss the trade, every time it comes up to the 50 EMA, jump in and take it. And there's been like 1, 2, 3, 4, 5, 6 opportunities. If you missed it back over here, 6 times to come into this. So, and you're going to see here that we just had another hard down day on Friday, down over one handle. Now, obviously, the ramification of bonds coming down like this is interest rates going higher. And look at the 10-year. I mean, I don't need to tell you from left to right on this screen, what is this chart doing? It's going up a lot. Just over here in August of last year, the 10-year yield was 50 basis points. Now it's at 1.345. That's 84 basis points higher. That's almost 1 percentage point higher. This is the 10-year. It will affect the mortgage market. It will raise mortgages, okay? For every $100,000 you want to borrow, every 25 basis point hike in a 30-year fixed mortgage is about $48 to $50 increase in the monthly payment. Okay, that's on $100,000 mortgage. So if you look at the national average of about 350,000 for a home, I guess, 300,000 or so, you're looking at about $150 to $175 increase in the monthly payment. And for a lot of people, that's a lot, right? For just an average home size. And that's every 25 basis points, $50 bump. So um, it's going to push home buying down or accelerate it to get all of this out of the way before we start to see it really take off. Okay. So just understand that. Now, the way to play bonds going lower is to just do TLT, right? Same chart, only it's TLT. Every time it comes up to the 50 EMA, load up on puts. It gives you another opportunity to go long puts in TLT. And you don't need to go out more than 30 to 60 days, okay? 60 days would be perfect. And then you can see here how it's just watershed down. Now, what I'm not advocating for is you go out on Monday and pick up puts. It's already extenuated from the extended from the 50 EMA. Give it a chance to consolidate, catch back up to the 50 EMA, then rock and roll with it again, right? That's a little bit about what we got in the credit markets. For our members, I'll go through some more detail in our weekly market watch this Sunday evening. Let's take a look at the dollar. Dollar is the same thing. Longer term should be bearish dollar. Near term, we're in this long consolidated phase here. Okay. I've recommended to our members, and again, as part of our low-hanging fruit trade, right over here in September of last year to go long the euro. And you can see the euro went up to my resistance level, overshot, came back down, and now it's sitting right at my resistance level. I think euro is going to be choppy, but then once it establishes its boundary, it's going to move up to the 125 to the 127 area up here longer term. The euro is going to fly. Remember, a lot of the money from Europe coming in here because our 10-year is at 134. Most of theirs are still underwater. So you're going to see money go where it's treated best, a la in our fixed income market versus some of the European fixed income market or treasuries. And when they start to improve, the money is going to be sucked out of the U.S. market, and you're going to see the euro just go up really nicely. And that's something you definitely want to play. All right. Now, there's other trades and other currencies. Members, I'll talk to you about those guys tomorrow evening in our weekly market watch. We've got a couple of new trades on in the metals market as well. I'll cover that for our members. But one area I just wanted to show you here is in gold. I think it's dead money near term. Longer term, I think gold is going to improve, but near term, no. It's just not holding above this downsloping trend line. It's not steady. I like silver better than gold. In some respects, gold is holding silver down, but look at gold. It's running sideways. Longer term, if you're going to play precious metals, play silver. Okay, it's going to be a little bit better than gold. Okay, if we come down to energy, well, again, as part of our inflationary bounce, if we take a look at oil, even though it was down on Friday, look at the oil markets, guys. I mean, and I just keep moving this thing up every time I log in and look at oil. Oil hit 62.26. It's going to pull back a little bit, but I think it's going to consolidate and then make another run higher. All right, and this is courtesy of wrong way Biden. Every time a Democrat gets in charge, energy prices and oil prices take off because they cut the supply, yet demand is still there, right? And as people are finding out, you just cannot power homes, cars, and other things with solar and wind. And battery, you can do a little bit, but not too much, right? It's going to take some time. I'm not against those forms of energy, but it's dependent on how you do the transition. A lot of people want to try and do the transition really quick to be popular with some voters and point it out, but they always end up with pie in their face. And that's what's going to happen again if the wrong way administration goes that direction. But for us, we don't care. From a trading perspective, we play the markets the way the price action tells us we should, and you want to be bullish oil. Okay, any pullback should be bought. If we look at nat gas, nat gas is at a level where I'm thinking about entering some shorts up here. Nat gas longer term is going to go down. Short term, because of the cold spell across the U.S. and the demand on natural gas, I just think it's going to be elevated up. Longer term, it's a sell. All right. If we look at gasoline futures, right up here. Oh no, that's the spread. That's the Brent WTI spread. But if we look at gas futures, let me just find that here. Here we go, right here. Gasoline futures, again, straight up, right? And gasoline prices like oil, we've gone from about 97 cents a gallon to $1.84 a gallon. All right, so that is just a huge move, really huge. And then, of course, we got the ag, meats, and softs. I'm showing a lot of inflationary data across all of those as well. So that's a little bit about what we've got going on, guys. Members, I will see you this Sunday evening. We'll take a look at some of the stock plays that we got. Some of them are really kicking booty. And we've got some new ones that we put on this week as well. If you're not a member, I highly encourage you to come in and check us out. We specialize in option plays against key asset classes from equities to futures, using futures as well as commodities. Have a great weekend, everybody. Members, I'll see you this Sunday evening. Take care, folks. Ciao.